people feel overwhelmed by financial instruments and IFRS 9 because it's complicated and deals with concepts and terminology that are often unfamiliar. However, financial instruments exist in every single business, and if companies you are involved with have trade receivables, then the new IFRS 9 accounting standard will apply to them. You'll be ahead of the game if you can wrap your head around the way it works now. So firstly, why the change in standard? Accounting standards relating to financial instruments have been around since the mid-1990s and were first adopted in Australia in 2004. There have been a number of updates since then, but the really big impetus for change was the global financial crisis in 2008. This highlighted that a lot of businesses, particularly banks, were delaying the recognition of credit losses on financial assets, which is believed to have contributed to the magnitude of the GFC. IFRS 9 was then introduced in 2014. So what's changed? Firstly, IAS 32, which covers definitions of financial assets, financial liabilities and equity, has not changed. You're probably already familiar with IAS 39 from your studies at uni or at work. The main changes between this standard and IFRS 9 are firstly, there's more principles and less rules. Classification is based on business and instrument principles rather than set rules, as well as the evaluation of hedge effectiveness. The credit loss model is now forward-looking. IFRS 9 introduces a forward-looking expected credit loss model rather than only recognising credit losses after a default has actually occurred. And thirdly, hedge accounting principles are now more closely aligned to how entities actually manage their business risks. Even though IFRS 9 is not effective until reporting periods commencing on or after the 1st of January 2018, a number of organisations, including Qantas and the NAB, have early adopted the standard as it provides benefits in hedge accounting and may lead to a more stable credit loss provisioning. Unit 9 covers the following aspects of financial instruments: definitions, classification and measurement, derecognition, hedging, and impairment. We mentioned disclosure briefly, but don't go into it in any great detail, and it's not part of the learning outcomes of the unit. There are a number of resources available to help you understand financial instruments. Firstly, there's the CSG. Because it's such a large unit, we've split it into two parts, which you can cover over 2 weeks. The first part covers definitions, classification and measurement. The second part covers hedging and impairment. Within the CSG, we've included a case study on a fictional airline called Fly by Day. This will give you the opportunity to cement your knowledge of each concept before you move on to the next one. Because of the case study, we don't have as many activities and worked examples as previous offerings. There are now 2 worked examples and 3 activities that cover specific aspects of the unit. In addition, there's a 4th activity that integrates all your financial instruments knowledge together. At the back of the CSG, you'll also find a few pages of definitions that will help you understand some of the terminology used. If you come across a word in bold in the CSG, you will find the definition of it in this section. There are also some videos, like this one, that talk you through key concepts and examples. Finally, there's obviously the standards themselves, which are in the Financial Reporting Handbook, or available on your local standard setter's website. Okay, so let's start with a few basic concepts about financial instruments. Firstly, what is a financial instrument? We have to go to IAS 32 for this. A financial instrument is a contract that gives rise to a financial asset in one entity and a financial liability or equity in another entity. You can see that the characteristics that define financial assets, financial liabilities and equity are their linkages to each other. Examples of financial assets are cash, trade receivables, or investments in bank bills. Examples of financial liabilities are trade payables or borrowings. Equity is the residual interest in the net assets of an entity. Ordinary shares issued by a company such as BHP are an example of equity from BHP's perspective. So to bring all this together, money you have in your bank account is a financial instrument because it's a financial asset of yours, being the balance in your account that you can withdraw at any time, and a financial liability of the bank because they have to pay it to you whenever you request it. So how to account for financial assets and financial liabilities is covered in IFRS 9. Another concept that can be quite tricky to understand is derivatives. Derivatives are financial instruments with special characteristics. Their value changes based on an underlying asset, index, or security. They have minimal or no initial investment, and they're settled at a future date. So an example of a derivative is an option to buy BHP shares. The amount paid up front is very small compared to the total value of the contract. The value of the option will change based on the share price of BHP, and it will be exercised or settled at a specified future date. FX forwards, interest rate swaps, and commodity futures are all examples of derivatives. These sorts of instruments are heavily used by entities that want to hedge their financial risks. We'll cover that in more detail in a future video. So that's it for the overview of Unit 9. I hope you found it helpful.